Now I move to the next chapter, assessment procedures, reassessments and appeals. And in this discussion only we will be covering even the amendments brought in the area of settlement commission and the authority for advance rulings also. Right. Assessment procedures definitely is a very important topic from the final examination point of view. So let us understand the amendments. So also we will try to understand a few important things, that is time limits for completion of the assessment and all, with the help of the examples. Now to start with, we have section 139. What is section 139? Return of income. See, you have got several returns of income: voluntary return to be filed before the due date, loss returns, belated returns, revised return, defective return. Now the point here is, there is an amendment in section 139, which amendment requires what? In case if the SSE has got any assets which are located outside India, then he has to necessarily file his return of income, even if the income is below the taxable limit. Normally under section 139, what it says, only when income of the SSE is exceeding the maximum limit up to which the income is not taxable. But now this amendment also, see, the point here is, there is a lot of a cry from social activists and opposition parties, and even the government also feels that how do we run this country without the money? And if all the money goes and sits in the foreign banks and foreign countries, naturally we have to have a modus by which we will get back all that particular money. See, point here is, we are not saying that citizens should not have any foreign assets or foreign income. We are only saying that you please disclose that. Then we will see whether that comes within the scope of Indian income tax or not. So section 139 is what? This section is amended from assessment year 2012 and 13, that is retrospectively, accounting year ending on 31/3/2012. The amendment now requires that a resident and ordinarily resident, because only resident and ordinarily resident is a big bakra, because the entire global income becomes taxable. Who is otherwise not required to furnish a return of income will be required to furnish his return of income before the due date for filing the return in the following cases. If the person has any assets located outside India, this will mean if the person owns any immobile property outside India, or any shares in a foreign company, or any bank account, or other assets outside India, he will have to file a return even if the total income is below the taxable limit. So how to remember this is most important. Applicability is only with respect to the resident and ordinary resident. Even if they don't have the taxable income, in case if they have got certain assets which are located outside India, it is now mandatory that they have to file their return of income. And then friends, if the person has any financial interest in any entity in a foreign country, this will mean that if any person is beneficiary in a specific or in any discretionary foreign trust, he will have to file his return of income, whether he has received any benefit from that trust or not. Similarly, if he is the signing authority in any account which is located outside India. See, point here is this particular provision is applicable to whom? That is a company, a firm, or an individual, or a HUF, or any non-corporate entity who is a resident and ordinarily resident. So, such a person will have to file a return of income for the accounting year 1/4/2011 to 31/3/2012 and there onwards. Now, the point here is how we are going to enlarge or widen the scope. We say whether you are a resident or non-resident. The moment you have got a taxable income, we are bringing a ITR which asks you to give the details of information regarding the assets which are located outside India. Not only that, we brought this and troubled the resident and ordinarily resident. Even for a non-resident also, in case if he has got taxable income and if he is filing his return of income, we have to provide the information regarding the assets which are located outside India. And then at the present, the due date for furnishing the return of income in case of an SC being a company to file a transfer pricing report. So, only with respect to the persons who require to file a report in respect of their international transactions under section 92E, they have got the due date till 30th November. Now, it is provided that this extended time limit of 30th November will apply to all SCs who are required to file the transfer pricing report under section 92E. In our previous classes, we have discussed about the specified domestic transactions, and with respect to the specified domestic transactions, we said that is you have to apply this arm length price, and in case if that exceeds a particular threshold limit, transfer pricing reference to the transfer pricing officer is to be given and all. Even for those SSEs also, this due date has been extended to 30th November is the second important aspect. So, now please take this particular amendment which is brought in section 139, that is a return of income and the due date for filing the return of income. Write down section 139, return of income. Return of income. Applicability. First side heading, applicability. This provision shall apply. This provision shall apply to A, company, B, firm, C, individual, D, HUF, or any non-corporate entity or any non-corporate entity who is a resident and ordinarily resident. Who is a resident and ordinarily resident. Now, point number 2. A resident and ordinarily resident. A resident and ordinarily resident who is otherwise not required to, furnish a return of income, will be required to furnish the return of income, before the due date, before the due date in the following cases, in the following cases. A, if the person has any immovable property outside India, comma, shares in a foreign company, or other way around, A, immovable property outside India, B, shares in a foreign company, C, bank account, D, other assets, E, financial interests, then F, beneficiary in any specific or discretionary trust, beneficiary in any specific or discretionary trust. Next, G, has got a signing authority, in any account located outside India. In all the above situations, in all the above SSC will have to file the return. SSC will have to file the return even if total income is below the taxable limit, Then the next aspect with respect to section 139 is what? Write down the next point. In case SSC is a resident or a non-resident, in case of an SSC, whether resident or non-resident, in case of the SSC, whether resident or non-resident, has a taxable income, in India, he will have to give information about the above said items, in the return of income, above said items in the return of income. Then friends, extended time limit. Next point is extended time limit. In case of an SSC, in case of any SSC, not just the company, in case of any SSE, who is required to file, transfer pricing report, under section 92E can file the return up to 30th November, of the relevant assessment year, Then friends, I move to the next section, 140A. What is section 140A? Your self-assessment tax. So self-assessment tax is to be paid after giving the tax credit both for the MAT and in case alternate minimum tax is applicable, alternate minimum tax. Of course, we have to take up that task of MAT provisions and alternate minimum tax provisions, that we will take up in the next sessions to come. But already about MAT and AMT, when we discussed the rates of tax, I gave a general idea about it. So in earlier years you have paid the MAT or AMT, now credit is available in respect of that. Then what is it? Self-assessment tax to be paid is after giving the credit for such a MAT or alternate minimum tax. Now tax payable on the basis of the return of income required to be furnished shall be determined after taking into account the credit claimed to be set off in accordance with the provisions of section 115 JAA and 115 JD. That is nothing but the alternate minimum tax. Please make note of it. Section 140 capital A. Section 140 capital A. Self-assessment tax is to be paid after giving the tax credit, both for MAT and alternate minimum tax. Then friends, I move to section 143. What is section 143 friends? That is, after you file your return of income, what will happen? What will happen is going to get decided by section 143. You have 143(1) intimation, 143(2) notice to be issued for taking up the case for scrutiny, and 143(3) your scrutiny or the regular assessment. Now, having got the understanding of what is section 143, what is stated here? Processing of the return of income where scrutiny notice is issued. Friends, try to understand the point like this. Now it is a mandatory on the part of the income tax department, whoever files their return, all the returns filed need to be necessarily be processed. Now we have brought almost 80% of the SSEs into the concept of e-filing. Now computer only will make the processing and will generate the intimations. But once upon a time, when this computer processing is not there, it is the assessing officer who has to do that kind of the processing and all, and need to send the intimations. In those days, if intimations are not coming, what we used to say, what the return that you have filed, that itself shall be deemed to be an intimation. Intimation you will get only when What is it? Either any refund is to be given to you or any tax is required to be paid by you. Now, even if there is no tax refund or tax liability to pay, intimations are getting generated under section 143(1). Now still 20% of the returns people are filing manually to the department. Now the point here is, let us suppose there is an SSE in whose case we have already issued a notice under section 143(2) asking the gentleman to come and show the books of accounts and get his assessment done. Then after that 143(2) notice is issued, is there any point in sending an intimation to that particular fellow under 143(1)? There is no point in it. Actually, after 143(1) intimation, case can be taken up for scrutiny and notice can be issued under section 143(2). Already you have decided to go through in detail all his return and the the exemptions and deductions which he has claimed, whether they are true or not. You want to take up the case for scrutiny, you have issued 143(2) notice. There is no point in saying that even in those cases also necessarily intimation is to be issued. First is intimation, then is the scrutiny. Reverse is not good. That is, after the notice, again troubling the department that even in those cases also you issue the intimation, that is not correct. Now they have made an amendment and said it officially. See, point here is processing of the return of income where scrutiny notice is issued. Subsection 1D has been inserted to section 143(1) to provide that processing of a return under section 143(1) will not be necessary in case where notice under section 143(2) has already been issued for scrutiny of the return. So the analysis part says what? If the return of income is filed and it contains a claim for the refund, and if the case is selected for scrutiny under section 143(2), then such a return shall not be processed under section 143(1). Why? Unnecessarily giving the refund and later on troubling the SSE that you have taken the excessive refund and you please pay the interest under section 234D. Anyhow, since you have taken up the case for scrutiny, please complete the assessment, and if after the assessment, if the SSE is entitled for the refund, you give it. Otherwise, if SC is required to pay some tax, you take that tax from him. So point here is the assessing officer shall make the assessment under section 143(3), and if he increases the income, then he shall adjust the refund claimed by the SC against the tax increased by him. If on completion of 143(3) refund is found due, it shall be granted under section 143(3). This is all for the good, and it's a beneficial provision only, even from the SSE's point of view also, not only from the income tax point of view. Please make note of it. Section 143, subsection 1D. Processing of the return under section 143(1). Processing of the return under section 143(1) will not be necessary in a case where notice under section 143(2), in a case where notice under section 143(2) has already been issued for scrutiny of the return, then friends, I move to section 143.3. What is the amendment? There are certain amendments which we have to carry out because in some other section there is an amendment. Consequently, here also you have to bring the amendment. Like such amendment only is being made in section 143.3. See, point here is charitable institutions. We already discussed this particular point. Charitable institutions and institutions covered by 1023C, what we said. In case if the institution has got its main objective as objective of general public utility, advancement of general public utility, then they cannot have receipts from commercial activity, business activity in excess of 25 lakhs, and in excess of 25 lakhs if they have, then exemption will be withdrawn. Even if what is it, the approval or the notification is withdrawn or not. Earlier, only when exemption and the notification with respect to that, only when it is cancelled or withdrawn, then only what is it, we used to say that such a income will be taxed. Now, irrespective of the fact whether that particular exemption is withdrawn or not, such income will be losing its eligibility for exemption is a point. Look at the point. Benefit of tax exemption not allowed to charitable organizations in case commercial receipts exceed 25 lakhs. Third proviso to section 143.3. So, third proviso has been inserted to section 143.3 to provide that first and second proviso shall not be applicable where in any previous year commercial receipts of such trust exceeds 25 lakhs. In other words, assessing officer shall not give exemption to such trusts covered under section 1023C even if approval has not been withdrawn or rescinded. So, following amendment has been made by the Finance Act of 2012. What it says, assessing officer shall not give the exemption under section 1023C or under section 11 and 12 in case of a trust or institution for the previous year in which first proviso to section 2 clause 15 becomes applicable, that is commercial or business receipts exceeds 25 lakhs. Whether or not approval granted to such trust or institution has been cancelled under section 12AA or under section 1023C. So, assessing officer will disallow the exemption under 1023C or 11 and 12 by operation of the law. So, now this section is being amended with retrospective effect from when? 1/10/2009. Under this section, when assessing officer want to make variation in the income or the loss, yes, this is slightly a different this thing. To this extent, you kindly make a note of the amendment which is brought in section 143.3. What is that amendment? 143.3. That is, third proviso has been inserted. Third proviso has been inserted in section 143.3. In section 143.3 to provide that first and second proviso, shall not be applicable, where in any previous year, commercial receipts of such a trust, exceeds 25 lakhs, In other words, assessing officer shall not give exemption even if approval has not been withdrawn or rescinded. Battery.